Hello, this is Adil, Mr. Intermarket Analysis, bringing you a review of the FTSE 100 for today, the 17th of April 2014. Okay, folks, so apologies once again, I've not been consistent with the videos, even though I did explain to you last time that I will start to show some consistency on a daily basis and go back to normality. But ever since the car accident, and obviously now I've got a flu, I've just not been 100%. So I'll try my best. I didn't even do a weekend video, which was very bad. So, but I will try and do as many videos as I can, or as soon as I get back to 100%. Okay, let's discuss the markets. Okay, so basically, what are the fundamental currents at play? Okay, so basically, the fundamental currents at play on the FTSE 100 in general, it's all about interest rates and sterling. Okay, so obviously we had the unemployment rate drop below the forward guidance barrier, shall we say. Okay, and that obviously triggered a short squeeze on sterling, and that obviously can hurt exports with regards to UK exports, and that obviously raises the possibility of interest rates rising sooner than expected, which again is a hindrance towards growth. So obviously the initial reaction for the FTSE was to obviously sell off, given the fact that you've got the higher interest rates going forward, and Mr. Carney's forward guidance really not being forward enough, and certainly failing to basically alleviate the concerns of higher interest rates sooner than expected, even though he has reiterated that he will not raise rates until he sees a sustained improvement in growth and jobs and etc. etc. So, but at present, that's been the way in which the market interpreted. Obviously, he's sold off and then obviously rallied on a short squeeze given the US markets. Okay, so that's basically the nutshell that we have with regards to UK fundamentals. The additional factor obviously right now is Russia-Ukraine. That geopolitical wildcard will always remain. Any negative news that can obviously throw everything in the throw a spanner in the works, and this inverted head and shoulders pattern that's obviously that exists here on 60-minute can fail within a second. Then we have Chinese data. China obviously slowing down. Not as obviously the GDP data, not as slow as expected. Although there are reports now, just reading from Bloomberg, that there will be another batch of data coming out that will confirm or basically contradict the one prior to it. So, as we all know, we can't trust Chinese data. It's all manipulated and skewed according to the government. So, government's projections, etc. So, again, we just have to take our variables, so we can observe copper to see the health of China. Obviously, just look at the health of commodities in general as well, although they are distorted to a large extent, especially oil and gold due to geopolitics. So that does make it slightly even harder. We can look at iron ore, for example. That's probably give us a better indication. But nevertheless, that's a concern. Okay, then obviously you've got the ECB down in the QE carrot, so that's obviously another variable that we have to take into account. So obviously any utterance with regards to QE, obviously the euro drops, and obviously that causes European equities to rise. European equities rise, the FTSE will obviously generally tend to follow, given the risk sentiment and momentum in the market. So that's another factor. Then you have Miss Yellen yesterday, obviously coming out being ultra well, uber dovish, obviously given her 6-month blunder. Okay, so obviously she's in damage control. Okay, so you can't really assess exactly what she's thinking right now because she's in damage control. So she's an absolute dimwit from my perspective. How on earth she became the Fed leader is beyond me. Okay, they probably just wanted an individual there to take the hit, and she obviously was the ideal candidate because she looks a bit stupid anyway. So basically that's basically the outcome there with regards to fundamentals. Now, if you look at the S&P 500, because this is the key chart, this is the chart that generally will give you, in terms of intermarket analysis, a heads up as to what's going to happen in the FTSE. You had a H&S formation. H&S formation obviously failed, given the fact that the algos have basically forced the market higher. And I did explain this as well last week. I was explaining this as well. With regards to my bias being higher, because you've got Easter holidays, light volume, algos going mad, Yellen put in place. So what happens? Spank every bear in sight. So that's exactly what's happening. So don't be shocked if we go back now on a continued short squeeze up to 1872 and 1890. I certainly don't rule that out. I honestly do not rule that out provided the Ukraine situation remains calm, provided Asia remains calm. then certainly yes, 1870, 1890, and I don't be surprised why, because they want everybody happy and joyful, and obviously into the weekend, and everybody's shopping over the Easter holidays and so on and so forth. Okay, and obviously they want to spank the Bears as well, knock out as many stops as they can, and obviously given Yellen's algos, that's their job to make the markets high, keep the markets afloat, and psychologically dent the Bears. Okay, and they've done that to a large extent, because the H&S formation has been declined, or negated, should I say, to a large extent, because the target was 1900 minus the 1845 level, so you're looking at around 1790 and lower. Obviously test this red trend line, possibly test the 200 MA, but obviously that didn't transpire, so H&S has been negated. Now once H&S is negated, then you get a continued short squeeze, and the market has an emotive move in the opposite direction. So certainly watch out for 1870, 1880 to be tagged, and then we'll see exactly what happens from there. Okay, now, well, why is this chart important? This chart is important because if you have a failed H&S pattern on the S&P 500, what does that mean for the FTSE? What does that mean for the FTSE? It means that there has a possibility of going higher now, given the fact that there will be a short squeeze on the S&P 500, which will obviously force the S&P 500 higher, which in turn forces the UK FTSE 100 higher as well. Okay, so let's have a look at the charts now, given the fact that I've covered mainly the fundamentals, but basically the most important part really is that unemployment rate in the UK falls to a 5-year low below 6.9%, or at 6.9%. That overall is positive for the markets, so from a pension fund manager, for example, or a retail investor, etc., that's looking for a long-term gain, then that obviously bodes well for UK 100 or the FTSE 100. So you'll certainly see some buying from there, just general investor confidence, etc. And because that generally means that you've got more people in work, more money in the economy, more individuals buying goods and services. That means more growth going forward, etc. Therefore, share prices should rise based on that concept. Okay, so that's basically bullish for the FTSE. So now let's have a look. Given the fact that we've got a bullish bias now because unemployment rate has fallen, then that basically means, and also remember that the fundamental strength of growth trumps any need for QE or any talk of QE, etc. So that in itself can create a short squeeze. So that's basically what we're looking for, a potential short squeeze on the FTSE to new highs. Okay, well, potential new highs, intra-week highs anyway. Okay, so let's have a look at the FTSE 100 now. So if I go to my daily chart of the FTSE, go to a daily chart now. Okay, not a 6-hour chart, I need a daily chart, come on. Okay, so basically what we have here is that obviously we've held this key trend line, knock. Okay, so basically that's important. That trend line has certainly held. You had a bullish engulfing candle, so you navigated yesterday's red candle. So who's in control? The bulls are back in control, and we're looking to potentially thrust higher. So on the high side, you're looking at potential target 6606, 200 MAs around the 6613. Then obviously the next level is 6640, and so on and so forth. So watch out for that on the daily chart on the FTSE 100. Let's have a look at the FTSE 250. FTSE 250, previous resistance equals support, a lower channel support. Expect this to go back to 16,000. So that again is bullish. Okay, let's have a look at the FTSE 350. FTSE 350, bullish engulfing candle, held as key trend line support again. Okay, and looking to go up to 3620, 3640, 3660. Bullish. Okay, that's basically your technical picture there. Okay, so let's have a look at the 10-minute chart, see if we can gauge exactly where this troublesome index is headed. Okay, so we need the FTSE. Okay, so look at a 10-minute chart. Okay, so let's have a look at a 60-minute chart first of all, because that basically tells you exactly where we're going. So we've put in a double bottom. Okay, so that bias change principle 1 is in place, so no more lower lows. You've put in a higher low, you've held a 50% Fibbo. Okay, and now you're looking for left shoulder, head, right shoulder. You have a projected target of around 6675, and coincidentally you have an unfilled gap around the 6650 level, and then you have this upper channel resistance or upper trend line resistance up here, which is around the 6660. So it's no surprise. Okay, there's certainly no surprise here. You're looking for a potential gap fill, and the market to close its gap and hit the target. So that's basically what I'll be looking for, and I'll be trading accordingly with my subscribers. Okay, now let's have a look at a 10-minute chart, see if we can see anything there. 10-minute chart, same thing. You've got a symmetrical wedge pattern here, so we're obviously consolidating. You've got the inverted head and shoulders pattern here, and looking for the potential gap fill up to 6645, and that's basically it. You do have an unfilled gap below around the 6540 level, Again, it depends on Asia. Provided Asia remains calm, provided there's no real sell-off in the US, which I can't really see, given the fact that Yellen's algos will be going mad, given the fact that Yellen was obviously dovish yesterday, so on and so forth. We'll see. Okay. Again, like I said, if Mr. Putin obviously decides to misbehave going into the weekend, then obviously that gap will be filled. Not only that, will potentially make new lows. So always remain remain on your toes, basically, light-footed, and always be flexible and willing to change your bias based on the news flow for the fundamentals, intermarket analysis, and obviously TA gives us a good guide as to what the next projected levels will be. Okay, so I think that sort of sums it up in a nutshell. This week has been fantastic so far, although last week wasn't very good. Minus 207 last week. This week so far 370 odd points. So neutralised last week's loss and made more. So can't really complain from that perspective. So the live analysis service is going well. If you do want to join, just visit my website. The details should be on YouTube, and there's a 1-week free trial to all new subscribers, and obviously existing subscribers are already receiving my analysis anyway. And obviously, hopefully the aim is so you learn, empower yourself, educate yourself, and then eventually you go solo. Okay, so risk on, risk off is my motto, and wax on, wax off. Goodbye.